In our strategy, we use a 5-phase macro framework. We are not predicting headlines. We are sequencing risk as conditions evolve. Japan's bond market was the quiet backbone of global finance. That quiet just broke. And when that happens, global markets usually react fast. We are reviewing a recent World Affairs in Context video. The original video explains Japan's bond shock in detail. Our role is to translate that signal into our strategy. Japan's 40-year government bond yield moved above 4%. That move was sudden, not gradual. For Japan, this is historically abnormal. This is happening because investors are questioning fiscal discipline. And when trust weakens, long-term borrowing costs rise first. Long bonds price confidence, not policy promises. The immediate trigger was political. Snap elections and looser fiscal signals were announced. Markets interpreted that as more debt risk. Japan already carries extremely high government debt. Low rates made that survivable. Higher yields changed the math very quickly. Recent long bond auctions showed weaker demand. That matters because auctions reveal real buyers. Weak demand forces yields higher to clear the market. In our strategy, this is a yield direction signal. It is also a global liquidity signal, and it connects directly to funding confidence. Short-term rates follow central banks. Long-term rates follow trust. This is where trust cracked first. For years, capital borrowed cheaply in yen. That money flowed into foreign bonds and equities. This worked because yen funding stayed cheap. This is happening because home yields are rising. And when that happens, capital often comes back home. Global liquidity tightens as a result. If Japanese investors repatriate capital, United States yields can rise even without strong growth. That tightens financial conditions globally. United States long-term yields rose alongside Japan. That is not coincidence. It reflects global term premium repricing. If Japan caps yields, the yen weakens further. If it does nothing, volatility increases. Either way, someone absorbs the loss. This aligns with late Phase 1 behavior. Markets can still rise, but fragility increases. It raises the probability of a Phase 1 to Phase 2 transition. Higher long-term yields compete with equities. They pressure leverage built on low-rate assumptions. This is why risk assets become more sensitive. Highly leveraged strategies feel this first. Carry trades and long-duration growth assets. This is why high beta exposure becomes fragile. If this continues, long-duration equities face pressure. Bonds face volatility before safety demand appears. Gold benefits as confidence insurance, not growth optimism. Quick disclaimer, this is educational macro analysis only. It is not financial advice. We increase sensitivity to global yield signals. We tighten exit discipline on risk exposure. We elevate funding and liquidity monitoring. This does not confirm a crash. It does not end Phase 1 participation with exits. It does not trigger forced de-risk behavior. Over the next 3 months, Phase 1 remains the base case. But downside risk increased versus last month. Fragility rose even if prices have not broken. Over 6 months, Phase 2 probability increased modestly. If yields remain elevated, timelines compress. This is sequencing, not timing. Over 9 to 12 months, Phase 2 becomes more plausible if funding stress spreads beyond Japan. Nothing here is automatic. We track Japanese bond auctions. We monitor yen funding stress. We watch long-term yields and equity breadth together. This is happening because trust is repricing, and when trust reprices, capital flows change first. Prices adjust later. We do not need to be early, we just cannot afford to be late.